Welcome to the EWF Bootcamp day number 11, Trading Psychology. Now if you remember, we talked about this before in the previous bootcamps. There are three factors for successful trading. And these three factors are an edge in the market, that is having a trading system that gives you an edge in the market or a higher probability of getting success on your favor. And then the second factor is aggressive risk management. And then the third factor is the proper psychology. So to get an edge in the market, we talk about the need to have a trading plan or strategy to write down in a trading journal a plan that has a complete rules. That is, it should have a logical entry, a logical stop loss, and a logical target profit. And this trading plan or trading system should give you an edge in the market and should give you a higher probability or a higher chance that things will go in your favor. Now the second factor here is the aggressive risk management. Once you have a trading system with a complete rules, then you apply aggressive risk management principle by controlling the risk to 1 to 2% in each trade. Also, in every trade, the risk to reward has to be always 2 to 1 at minimum. Now we learned about risk management in the previous days of the bootcamp, and we learned how important it is to know the right position size with the position size calculator, so you stay within this guideline of the 1 to 2% risk. So we have a system or a plan that gives us an edge, and we apply aggressive risk management principle. Now this system right here, if you are still not familiar with our system, you can always look at the live trading room and also strategy of the day, strategy of the week to follow our way of trading. Then all you need to do then is applying the risk management principle by opening the right position size to stay within 1 to 2%. So these two factors here, in other words, you already have it with EWF. Now the last thing that you need to have really is the proper psychology. Now the aggressive risk management, you can apply it, you calculate the right position size, and then the last part here is the proper psychology. We need to have the right psychological makeup to stick with the trading plan and the risk management. This is where the human psychology plays into part, because when we start to violate all these rules, which is the number one and the number two, when we start to trade with emotion without any plan, for example, when we start to risk too much in a trade, we start to risk a lot, and we start to have no stop loss, this is where the psychological part comes into play, and we fail into trading because we do not have the proper makeup in the psychological area. Now let's talk about 4 types of psychological emotions. Number 1 is greed. So greed is the excessive desire for money and wealth. Very, very common. And this is thinking only in terms of the dollar and profit without considering or quantifying the risk in the trade. So in other words, you only think about making money when you do the trade, and you never really consider seriously the risk in the trade, and you do not try to quantify how much risk in the trade that you take. So this usually results in over leveraged position because you are being greedy, thinking in terms of how much profit you can make, and also usually result in too much risk in a position because it never is calculated properly to begin with, and then also keeping the position longer than should have been, causing the market to turn against you again after being profitable. So in other words, even if things move in your favor, because of greed, you open the target profit and you think that it will go more than what you expect, and so things can get, because of the greed, you open the target profit, and then market can turn against you again and go back to your initial position after being profitable. So now after the market turns against you, that profit is lost. So in other words, you have to stick with the plan. When you have the stop loss in place and when you have the target profit in place, you calculate everything in the trading journal, then this problem here in the grid should not be a problem. Now the second psychological emotion is fear. Fear is distressing emotion caused by impending danger resulting in survival response. So the symptom of it is afraid to take the trade although it has fulfilled the trading plan criteria. In other words, you already planned for it, but you see the market moves strongly into, let's say, into your trading, into your limit order, and you get scared of taking the trade. Even though you already limit your loss into 2% and so on, you do not take the trade because of fear. And fear also results in overanalyzing instead of sticking with the simple plan that you use. You overanalyze things and not able to make any decision. Another type of fear is fear of losing money, and this is very dangerous because it usually results in a position without stop loss because you do not want to take any losses. And so it becomes too late until it becomes too late and the losses get too big before you close your position. But if you apply the risk management with discipline and trusting your game plan, then every trade should be taken without fear. And you should understand that every trade has probability of losing as well, but as long as you limit the losses to 1 to 2%, then you should not have any fear in the trade. Now the third psychological emotion is hope. Hope is feeling of expectation and desire for a certain thing to happen. So the symptom of it is hoping that the market moves back to your entry level or position that is unprofitable becomes profitable again because it moves to your favor finally. So this hope feeling here usually results in people having a position without stop loss and then thinking and hoping that it will go back to their entry level even though it is under the water. And it is a very dangerous emotion because sometimes the market keeps moving against you until it becomes too late, and then you lose all your capital as a result. Now finally, the last emotion here is regret. Regret is feeling of sadness or disappointment over something that has happened. So an example is regret for closing a position too early, regret for not taking losses early, regret for missing a trade. But you need to remember that losing is part of trading. It's not about winning or losing. It's not about trade by trade basis, but it's about a series of trades. And also you need to remember that you cannot catch every swing and every winner. So there is no point of regretting for missing a trade. There will always be a trade in the future. There will always be a setup in some instrument in the future. Now, if you stick with the game plan every single time, you always have a target profit, you always have stop loss, then there should be no regret at all in any trade because you stick with the plan. So even if things move further than your target profit, there should be no regret because in fact you never know whether it is going to keep moving or whether it is going to turn. And similarly, you should not regret for taking losses early. You should always place your stop loss. Therefore, there should be no regret if things really go against you. If you take the losses early, then you should not have any regret. You will regret if you do not put any stop loss and things move against you constantly and do not go back in your favor. So in other words, these 4 psychological emotions right here is what makes traders violate the game plan. The game plan has always been written in a journal with the specific criteria of entry, stop, and target, and also applying the risk management principle by risking 1 to 2% in each trade. So you should not get any emotional attachment to any particular trade here, and calculating the right position size. So when traders start to violate this first two, which is a trading plan and also the risk management, it is because one of the psychological emotion comes into play, whether traders being greedy or being fearful or being hopeful that things will get better and it's not, and being regretful. So I hope you understand the psychological part of trading. It is very important to understand these 4 types of psychological emotion so that you know yourself when things go bad, what is the problem, and then you can fix it. Thank you for watching, and I'll see you all again next time.